Bharat has written in, he's 60 years old, Dhirendra, and he's invested in mutual funds, which he tells us contribute to 50% of his annual income. Now, he wants to streamline his portfolio and consolidate his funds. We have to remember that he's retired and he's deriving an income from these funds right now. And he has a very large list of funds, and I'm going to take them in groups of fund houses. So his first list is HDFC Equity, HDFC Mid-Cap Opportunities, HDFC Growth, HDFC Balanced, and HDFC Multi-Cap. Now, he doesn't need to have all of these in his portfolio. Obviously, if you could just pick one that he can invest his money in, what would that be?
I would say, given his expectation and 50% of his income being derived from these funds, I think he needs to get really stable, into the most stable fund from this selection. I would say he should focus on HDFC. He should move all his money to HDFC Balanced, and it will be a compromise on return in good times in a rising market, but it will save him a lot of anxiety. At the same time, he will be able to beat inflation, which should be his goal in retirement.
The next on his list are funds from the Reliance Fund House. He has Reliance Vision, Reliance Growth, and Reliance Equity Opportunities. I'm not really sure how this will fit in for someone who is in his age group, but is there any among these that you'd like him to hold on to?
Yes, I think Reliance Equity Opportunity is an impressive fund of the three that he holds. But given his expectation from his investment and depending for 50% of his annual income from these investments, I think he should avoid equity altogether. The ideal thing should be either getting into a MIP or at most 30 to 40% into balanced fund, remaining into MIP. I think our income-oriented portfolio, which is designed with this objective in mind, that you invest your money, it should be able to beat inflation. I think those goals will be met with that portfolio.
All right, our income-based portfolio is flashing on your screen right now. Remember, Dhirendra said in your age group, this would ideally be the funds you should be investing in. But let's go back to the portfolio, Dhirendra. The rest set of funds also look very similar. Franklin India Blue Chip, Franklin India Prima Plus, Templeton India Equity Income, and Templeton India Growth Fund. Now, among these, would you recommend he hang on to at least one of them, or should he be pulling his money out of all of them at this point?
In fact, all the four funds are good, but they don't match with his goals. He should, seriously consider moving all his money into these funds. He will be exposed to the Templeton Equity Fund, Equity Universe. If he has to simplify based on his existing portfolio, I think he should move all his money to Templeton India Balanced Fund.
All right, Bharat, that's the advice you're getting right now. This portfolio might have been great to accumulate your money up till now, but now that you are in retirement, you need to change your investment strategy. Now, one of the things that you can do, like Dhirendra said, is consolidate your portfolio into HDFC Balanced, Reliance Equity Opportunities, and Templeton Balanced Fund. Now, alternatively, we have a portfolio that's designed from someone exactly like you. That's our income-based scheme that's flashing on your screen right now. You can use that one as well to substitute the investments that you have at this point. Good luck, and write back to us if you need anything else. We have a quick question from Kanika, Dhirendra. She tells us she makes 9 lakh rupees a year. She wants to build a corpus of 25 lakh rupees in 2 years. Now, the good thing is she can invest her entire income and she can put all of that money away. The bad thing is she wants a return of about 40% in 2 years from that money. Do you think that's possible at all?
It can't be ruled out. There has been occasion, when the market has gone up by 100%, but it is not a bankable thing. In fact, those kind of returns are generated when you least expect it. And trying to get a predictable 40% in next 2 years, given that you only have those 2 years, there is a great possibility that you might earn 20-25% annual return on your investment year on year. Next 2 years, this time frame, serious goal, it is a very unreasonable expectation. And for this kind of time frame, one should not be taking any chances. If somebody comes to me with a 2-year time frame in mind, I normally suggest keep your money in the bank or put your money in a short-term fund, which is unlikely to deliver anything more than 8-9%.